Joining our closing bell exchange, Samantha Azzarello is here, global market strategist at JP Morgan ETFs. Steve Grasso, CNBC market analyst from Stuart Frankel, and of course our own Rick Santelli joins us today from the CME Group. So Samantha, you see the speech, the U.S. rejects globalism. What are the investor implications, if any, for that?
So I think there's a lot of noise. Not that what the administration says is noise, but we know unless it gets impacted through policy that businesses have to deal with, then it really just is noise. So
isn't that with trade?
I think so. I think the trade stuff, it's interesting because it hasn't shown up in any of the real economic data. It's only shown up through sentiment and then through international underperforming. But it hasn't shown up in any of the inflation data or any of the GDP that we forecast.
Steve, do you agree? Do you think it's just noise as opposed to fundamentally something that should be dragging the market down?
We've heard it from day one. We've heard it actually before President Trump was President Trump, when he was candidate Trump. So this is on a continuous basis. He talked down the dollar when he was candidate Trump. That worked. So he's had a bunch of issues. Seems to me it's all rhetoric. Hasn't had a really big impact on the market as of yet. And I wouldn't think that we're going to see anything different right now.
Rick, 10-year yield, 310, highest level in months. What's the driver?
Oh, the driver's best conference board consumer confidence in 18 years. A litany of reasons why, maybe not the least of which is that the UN doesn't run our economy. Because I guarantee if they did, I doubt if we'd see a 311 yield. We always forget that in the end, globalization was more about, think of the times the League of Nations would put forth, World War I. Woodrow Wilson. It was usually about conflict. When it now moves into trade, that's where the issues start. Not to get off the topic, but I see rates continuing to go up. Will they go through like a hot knife through butter? They could. I don't personally think they will, but I wouldn't be shocked to see 317, 318, 320 very quickly here. And when it comes to rates, it isn't only the U.S. A two-year note in Europe was hovering around minus 49, minus 50 basis points. That's darn close to the highest yield, even though it's negative, since April of 2016. So you're starting to see this. Even the gilt in the UK with all the issues of Brexit and questions about their economy is also about the same place, about ready to pierce a level we haven't seen since the spring of 2016. So I think all of this should be expected. When you see record stocks, you're going to ultimately see higher rates. And if stocks don't mind, you're going to see more higher rates.